All right, picture this. You've got a nice stack of Bitcoin. You're feeling good. Then some slick platform slides into your DMs promising easy loans or juicy yield, and suddenly half your wealth vanishes like a ghost in the night. No hack, no rug pull, just three mistakes you didn't even know you were making. Today, I'm breaking down the three Bitcoin lending mistakes that have absolutely wrecked people. We're talking 50% wealth destruction, and more importantly, how you avoid becoming another cautionary tale in the Bitcoin Hall of Shame. Quick heads up, this is for educational and entertainment purposes only, not financial advice. Do your own research, folks, and consult a pro before making moves. So here's the deal. Bitcoin lending sounds like a no-brainer, right? You've got this appreciating asset just sitting there, and platforms are offering you the chance to borrow cash against it or earn yield on it. It's like having your cake and eating it too, except when it's not, and you end up with no cake, no Bitcoin, and a very expensive life lesson. The wild part? Most people making these mistakes aren't crypto newbies. They're seasoned investors who just didn't understand the fine print, and that fine print is written in financial landmine language. Let me give you the scary number that should wake everyone up. During the 2022 collapse, 4.3 million people using major crypto lending platforms lost a staggering $46 billion. Not because they made bad trades, not because they got hacked, but because they fundamentally misunderstood how these lending products work. And we're not talking 10% losses. We're talking total account obliteration for some folks. So buckle up, because we're about to dive deep into the three mistakes that separate the Bitcoin survivors from the Bitcoin statistics. Mistake number one, and this is the big one, over-leveraging your Bitcoin like you're playing financial Jenga with your future. Here's what happens. You own one Bitcoin. Current price? Let's say 100 grand. You find a lending platform that offers you a 50% loan-to-value ratio, meaning you can borrow $50,000 against that Bitcoin. And you think, holy cow, this is genius. I keep my Bitcoin exposure. I get cash to deploy elsewhere. Maybe I even buy more Bitcoin with that borrowed money. You're basically feeling like a Wall Street wizard. But then Bitcoin does what Bitcoin does. It drops 30% in a brutal sell-off. Now, your Bitcoin's worth $70,000, but you still owe 50 grand. Your loan-to-value ratio just rocketed from 50% to over 71%. And guess what happens when you hit most platforms' liquidation threshold of 75 to 80%? They dump your Bitcoin to cover the loan. Game over. You went from owning a full Bitcoin to owning absolutely nothing except a brutal lesson in risk management. This isn't theoretical horror. This is exactly what massacred thousands of people in 2022, when Bitcoin plunged from 60,000 to under 20,000. People who took out loans at 50% LTV when Bitcoin was cruising at 50 or 60 grand suddenly watched in horror as their positions got liquidated on the way down. They didn't just lose the ability to borrow, they lost their actual Bitcoin. The platform auto-sold it to cover the debt, and these folks went from Bitcoin holders to Bitcoin mourners. That's not a portfolio correction. That's financial annihilation. And the worst part, it was completely avoidable. The solution is brutally simple, but requires the discipline of a monk. Never borrow anywhere near the maximum loan-to-value ratio. If a platform offers you 50%, borrow 30% max. If they're pushing 60%, stay at 35 to 40% tops. You need a cushion so thick that even if Bitcoin nosedives 40 to 50%, which it absolutely can and has done multiple times, you're still miles away from liquidation town. Think of it like this. Bitcoin is volatile. That's not a flaw, that's its personality. If you're going to use Bitcoin as collateral, you better respect that volatility by giving yourself massive room to survive the wild price swings. Overleveraging is the express lane to turning a temporary dip into permanent poverty. But wait, because it gets worse. Mistake number 2 is where people think they're being smart, but they're actually walking into a trap disguised as free money. This is the mistake of chasing yield by depositing your Bitcoin on platforms without understanding counterparty risk. Let me paint you a picture that'll make your stomach turn. You've got your Bitcoin just sitting in a wallet doing its thing. Then you see an ad, some platform promising 8% annual yield if you deposit your Bitcoin with them. 8%. That's way better than the 0% your Bitcoin's earning just chilling in cold storage, right? So you transfer your precious sats to this platform, they pinky promise you 8% returns, and you kick back feeling like a financial genius. Except here's what actually happened. You just gave up control of your Bitcoin. When you deposit Bitcoin on a lending platform to earn yield, you don't own that Bitcoin anymore. The platform owns it. They're taking your Bitcoin and lending it out to sketchy hedge funds, trading desks, or who knows what. And you've got zero visibility into what they're actually doing with your money. You're trusting strangers with your hardest asset on earth because they waved a shiny 8% carrot in your face. And when things go sideways, which they did spectacularly in 2022, you lose everything. This is the Celsius, BlockFi, Voyager disaster. These weren't no-name fly-by-night operations. These were billion-dollar platforms with celebrity endorsements, Super Bowl ads, and an army of influencers shilling them. Millions of people deposited their Bitcoin to earn yield, thinking these platforms were bulletproof. Then the market crashed. These platforms made catastrophic bets with customer funds, and they all imploded into bankruptcy faster than you can say, not your keys, not your coins. And you know what happened to the people who deposited their Bitcoin? They got stuck in bankruptcy court hell, waiting years and counting to maybe, get a fraction of their Bitcoin back. That 8% yield turned into a 100% loss. This is the ultimate sucker's bet, and thousands of Americans fell for it because they prioritized convenience and greed over security and sovereignty. The harsh truth? Not your keys, not your coins isn't a meme. It's the first law of Bitcoin survival. If you're nodding along thinking about your own setup, what's one thing holding you back from full self-custody? Share in the comments. I read them all, and I'm genuinely curious what's stopping people from taking control. The fix here is non-negotiable. Keep your Bitcoin in self-custody and accept zero yield. Or if you absolutely must chase yield, only use non-custodial solutions where you maintain control of your private keys. And even then, only deposit a tiny percentage of your stack that you're fully prepared to lose. Because let's be crystal clear, anytime you're chasing yield by giving up custody, you're not investing, you're gambling. And if you're going to gamble, never gamble with money that'll ruin your life if it disappears. Now, buckle up for mistake number 3, because this one's sneaky and it'll catch you even if you think you're playing it safe. This is the mistake of not understanding how interest accumulation and refinancing work, and it's a slow-motion train wreck. Let's say you've been smart. You borrowed at 30% loan-to-value, you've got a fat cushion, you're nowhere near liquidation. You're feeling like a responsible Bitcoin borrower. But then 6 months roll by. Bitcoin's price has actually gone up. Nice. Your loan-to-value ratio looks even better now. You're feeling confident, maybe even a little cocky. But here's the silent killer. Your loan has interest accumulating. Depending on the platform, you could be paying anywhere from 8% to 15% annual interest. That interest doesn't just evaporate, it gets added to your loan balance. So even if Bitcoin's price stays flat or climbs, your loan balance is quietly growing like a weed. And if you're not paying down that interest regularly, or you're not adding more collateral as your loan balance swells, you can slowly drift toward liquidation without even noticing until it's too late. I've personally seen people get liquidated not because Bitcoin crashed, but because they forgot about their loan for a year. The interest compounded like a financial snowball from hell. Their loan balance exploded, and suddenly they were at liquidation threshold, even though Bitcoin's price had barely budged. This is especially brutal if you took out the loan and then just forgot about it. You're not actively monitoring it. You're not checking your loan-to-value ratio. You're not prepared to add more Bitcoin or cash if needed. That passive approach is a ticking time bomb. The other side of this mistake is not understanding refinancing options. Some platforms let you refinance when your loan-to-value improves. Maybe you can borrow more without adding collateral, or you can lock in a lower interest rate. But if you don't understand these mechanics, or you're not actively managing your loan like a hawk, you're either leaving money on the table or setting yourself up for a disaster you won't see coming until it's game over. The solution is brutal simplicity. Active management or don't borrow at all. If you take out a Bitcoin-backed loan, treat it like the serious financial obligation it is. Set calendar reminders to check your loan-to-value ratio at least once a month, maybe even weekly if you're in a volatile market. Know exactly how much interest you're paying and when it capitalizes onto your balance. Understand your platform's liquidation threshold down to the decimal point, and make sure you're always at least 20% away from danger. Have extra Bitcoin or cash sitting on the sidelines ready to deploy as collateral if the market turns ugly. And most critically, have a concrete plan for how you're going to repay the loan. Don't just borrow money with some vague hope that you'll figure it out later. Know exactly where the repayment funds are coming from and when they're coming. Anything less is financial Russian roulette. So let's bring it home. The 3 Bitcoin lending mistakes that can vaporize 50% or more of your wealth. First, overleveraging by borrowing too much against your Bitcoin and getting liquidated when the inevitable volatility hits. Second, chasing yield by depositing your Bitcoin on custodial platforms without understanding the catastrophic counterparty risk you're swallowing. And third, not actively managing your loan, forgetting about interest accumulation, ignoring your loan-to-value ratio, and failing to understand your refinancing options. These 3 mistakes have absolutely demolished countless people, turning Bitcoin believers into Bitcoin refugees. But now you know what they are, why they're deadly, and exactly how to dodge them. Bitcoin lending can be a powerful tool when wielded correctly. Borrowing against your Bitcoin instead of selling can help you unlock liquidity without triggering a taxable event. Uncle Sam doesn't get his cut, and you keep your Bitcoin exposure. Using Bitcoin as collateral can let you access capital for investments, emergencies, or opportunities without giving up your seat on the rocket ship. But these tools are sharp as hell. They'll cut you deep if you don't respect them. The key is education, discipline, and paranoid-level active management. Never over-leverage. Never give up custody for yield unless you genuinely understand and accept the risk of total loss. And always, always manage your loans like your financial future depends on it, because it does. If you found this video valuable and it potentially saved you from a catastrophic mistake, smash that like button. It genuinely helps the algorithm blast this to more people who need to hear it. If you haven't subscribed yet, hit that subscribe button and ring the bell so you never miss a video where I break down Bitcoin strategy, security, and the landmines that blow up portfolios. Share this with your crypto crew because the more people who understand these risks, the fewer people get wrecked. And drop a comment. What Bitcoin topic should I tackle next? Bitcoin security deep dives? Tax strategies? How to evaluate custody solutions? Let me know what would help you level up. Thanks for watching, stay sharp, stay sovereign, and I'll catch you in the next one.